In this lecture, we're going to talk about leases. A lease is a contract where the lessor conveys the right to use an asset to the lessee. So take, for example, a truck or some other type of equipment. It's owned by the lessor, but the lessee uses it. In exchange, the lessee pays the lessor some type of rent. Why are we talking about this in the financial statement analysis course? Well, to explain that, let's look at an example. So our company has some delivery trucks. It's a delivery service. They have 10 trucks. And so the managers in the company are supposed to take those trucks, make deliveries, and through those deliveries generate profits. Then what we can do is we can evaluate the managers by seeing how much profit they made compared to the number of trucks they have. In this case, we had 10 trucks and they generated profits of $50,000. So we have a 25% return on those assets. If managers can make more profit from those trucks, then that percentage is going to go up and the managers are going to look like they're doing a better job. If the business expands and they get more trucks, then managers can use more trucks to generate more profit. However, because they have more trucks and more profit, then really the return on assets is not improving any. Managers aren't doing more with the same amount. They're doing more profits because they have more assets to use. Wouldn't it be great if managers could generate more profit but have the same amount of assets? Well, generating more profit with the same amount of assets is pretty difficult. Another option, if managers are savvy, is to maybe get the ability to use more trucks but only have the same amount of trucks on the books. So for example, on the balance sheet we only have 10 trucks, but we lease 5 more trucks. So that way they're not on the balance sheet. They're not considered assets of the company. We're using those trucks to generate profits. Now we have $70,000 in profit, but the assets stay at 10 trucks or $200,000. So instead of 25% return on those assets, it looks like we're getting a 35% return on assets. It's not that we're making a lot more profit from the same trucks. It's that we're making more profit because we have more trucks. But we're able to keep those trucks off because we've used leases. This is a tool managers have used in the past in order to have some control over the financial statement analysis and evaluation. When we're talking about leases, we have to understand that leases can vary in many different ways. And one of the key ways that leases can vary is through the duration of lease. So let's say we have an asset with a 10-year life, maybe like a truck. If the asset is used for only a short period of time, closer to the first year the asset's around, they usually call that an operating lease. And if the asset's used for most of its life, in this case we're expecting it to last for 10 years, they would call that a capital lease. An operating lease is better for the management of the lessee. The reason is because the asset stays on the books of the lessor. So the leasing company keeps the asset on their books and it stays off the books of the company using the asset. That way that company can generate profits but not have more assets and they can have a higher return on assets. A capital lease is a situation where the lease is treated as a sale. It doesn't help the managers of the lessee. The reason is because the asset is used a significant amount of time of that asset's useful life, and so it's treated like a sale, therefore going on the books of the lessee. So it actually leaves the books of the lessor and goes onto the books of the lessee. So the lessee wouldn't get any of the benefit of the lease if that was the case. Leases are still useful, whether they're capital or operating. It allows access to assets without big spending. In other words, the lessee can access large equipment, for example, if they need it, without having to go out and purchase large equipment. It protects the lessee from obsolescence. If you're leasing the equipment, latest and greatest comes out, then you can update the equipment. And there's also tax incentives because of the rent expense and the reduction of the taxable income. So it was no secret that the managers of the lessee companies were looking for ways in order to improve their financial statement performance. They were using leases, as we said earlier, to gain access to assets without having to actually put the assets on their books. However, the Securities Exchange Commission didn't believe this was accurately portraying the true effects of the lease on the financial statements. In other words, they understood that the management was using this as a way to game the system. The SEC believed more leases should be treated like capital leases rather than operating leases. In response to this, the Financial Accounting Standards Board ended up making some changes to the GAAP accounting rules. ASC 842 changes the way leases are categorized on the financial statements. Basically, it's a 1-year cutoff. So leases with a term of greater than a year are going to be considered capital leases, meaning it's going to be treated like a sale and moved to the lessee's books. Leases with a term of less than a year are short term and are treated as an operating lease. Basically, this means that most of the leases that management was using were going to now be treated like a capital lease rather than an operating lease. Now that you understand the reason that managers use the leases as a tool for manipulating the financial statements and having some control over how they are presented, there's some other terminology that is useful to know in the discussion of leases. One of the types of leases is called a sales type lease. Basically, the lessor is assumed to sell the product to the lessee. The lessor therefore recognizes profit or loss on the sale, and the asset is removed from the lessor books. A direct financing lease is very similar to a sales type lease. The major difference is that the only profit that's recognized is from the interest from the lease agreement. You could think of the lease as a financing vehicle. Another leasing strategy that's been used in the past is called a sale leaseback. A sale leaseback means one company sells an asset to another company and then immediately leases it back. So you sell a truck to another company, and then you turn around and lease the truck right back from that other company. Seems kind of odd. Why would they do that? Well, there are financing and tax reasons for this. It gives the seller profit from the sale, while the buyer gets future rental income. So it's a way for both companies to try to come out ahead. And then a final term that we're going to look at is called guaranteed residual value. This is where a lessee guarantees an asset has a minimum value at the end of the lease. It's like saying, I'm going to rent this crane from you, and I guarantee we're not going to tear it up. It's going to be worth a certain amount by the end of the time we lease it from you, and if it's not, we'll pay you for the problems that you have, the difference. That's what a guaranteed residual value is all about. And our last term is executory costs. These are just the cost of using the asset. So you have a crane or a truck or equipment of some sort, and there's maintenance, tax, insurance. Those are all things that need to be paid on the asset. Who pays for it, the lessor or the lessee? That's all written into the contract, but those are called executory costs.